A topic that seems to be coming up much more in the factor space is value investing, with increased coverage at conferences and in quant research. Well, I think one of the main reasons is actually the disappointing performance that we've seen, particularly in the US. A lot of the value ETFs have had a very bad track record over the last 10 years. So naturally this means people want to review the definition and understand more about why that's happened. Well, I think so. They do have a very high beta, and that means basically that the returns we've seen from value, that's not explained by the market. It means it's explained by something else, and perhaps it means that the definitions that we've been using across the industry have actually not been able to explain the cross section of returns. So the question now is that likely to continue, or is there likely to be a big rotation back into value, and we'll see a very big rally to come. The most popular and the most simple definition really is price to book, which is very simply just the price of a stock divided by its book value. But this definition, it suits some industries much more than others. So it obviously is very suitable to something like an investment trust or a REIT, where the intrinsic value of the company is obviously linked to its book value because it has a lot of assets. But on the contrary, a big stock like Amazon, where there's a lot of intangible assets, perhaps, the price to book is less relevant. So clearly, there's a lot of generalization across the industries. While the average price to book of the market itself is not an all-time high at the moment, what's interesting is that the dispersion across stocks of their price to book values has been steadily increasing over the last 10 years. So if you take the price to book of the top decile divided by the price to book of the bottom decile, this number is typically around 5 times. But at the moment that number is 10. In fact, it's just over 10. The last time it reached this value was actually back in 2000. And the time before that was actually in the early 1930s. So clearly this doesn't happen very often, so something has changed. So this means two things really. Firstly, there could be a rotation away from growth and back into value, so we'd see value stocks outperform. But this could also mean, this could also be a sign actually that price to book is not able to explain returns anymore like it used to. And this could be for a number of reasons, but potentially because the market is now dominated by mega cap stocks that have very high valuations and potentially low tangible assets, which means that the price to book doesn't explain necessarily the cross section of returns. Well, firstly, of course, you need to use multiple different definitions and combine them together. This is important so that you have a generalized approach that works across all stocks and across all industries. But further to this, we're also doing a lot of research into the value premium and how to enhance, how to capture this in a better way. One way is to refine value using some quality signals such as dividend cover, debt, cash flow. We're also using filtering techniques in order to remove some of the noise from the signals. And of course also we're using some machine learning techniques such as decision trees, different classification models to try to capture some of the more complex relationships going on in the market.